Well, good morning, friends. Jagendra Rana here. We are taking up today marine transit insurance policy. Marine transit insurance policy. So, in this policy, marine transit coverage for anywhere in the world to anywhere in the world is most common. I repeat, marine transit coverage for anywhere in the world to anywhere in the world is the most common terminology. But these are very vague terms which would unnecessarily put the underwriters in a tough situation, especially when claims are reported under such policies. On going by the experience, we should caution our operating offices or to the offices of the insurers not to issue such ambiguous covers. It should be ensured to ascertain beforehand the countries from or to where the dispatches are likely to be made, and the same is incorporated in the policy at the time of issuance. It is also relevant to draw reference to Foreign Exchange Management Insurance Regulations 2000, also known as GIM rules, issued by the RBI under para A4. The relevant provision of the para is like this: premiums on marine policies covering shipments between countries outside India. This is the title of that relevant provision of GIM rules issued by RBI under para A4. Premiums on marine policies covering shipments between countries outside India. What does it say? So this para A4 says, sometimes firms and companies in India finance merchanting trade, that is goods shipped from one foreign country to another and financed by an intermediary in India. So in some of these cases, goods may be purchased on a FOB basis, C&F terms, and are sold on CIF terms. FOB means free on board, C&F means cost and freight, and are sold on CIF terms, that is cost, insurance and freight. So the marine insurance cover being arranged by the intermediaries in India, insurance companies registered with IRDA may issue policies covering transit risk between the loading and the destination ports in rupees or in any foreign currency. In such cases, against payment of premium in rupee by the intermediary, after satisfying themselves that the contract provide for marine insurance being taken by the intermediary. So this is para A4 of GIM rules issued by the RBI under the title of premiums on marine policies covering shipments between countries outside India. Now the question is, similarly, policies are issued to cover dispatches from anywhere in the country to anywhere in the country. No such policy should be issued without specifying the originating point or destination point to avoid disputes in the event of a claim. There may be cases where the insurance is arranged by the overseas suppliers up to the destination port, in which case the buyer may seek cover from that port of their warehouse. So it should be ensured that proper inspection is carried out and the policy issued incorporating the observations of the inspecting agency. So relating to marine cargo policy, There are certain facts, not myths, facts. The one is general average is declined by the owner of the vessel. Second, general adjusters are appointed by the ship owners. If the cargo owner takes delivery of the cargo at the port of destination, the general average claim is still payable on submission of cash received by the insured. A specific approval from the insurer must be obtained for granting marine cargo cover on export to Iraq. Institute trade clauses are used to meet the special requirements of particular trades. The cover under the tea crop insurance can be extended to cover the risk of hail damage to standing tea crops. General average claim is computed on the invoice value. The apportionment of general average contributing interests are guided by York Antwerp rules. International Maritime Bureau provides assistance in regard to vessel, port details, and also investigation of marine claims. H/C is given in the schedule of war risk. Rates